Good morning and welcome to the tax edition of the Call Brief podcast. I'm Christine Tidgren here at the Center for Agricultural Law and Taxation, and thanks for tuning in. It's mid-August. It's hard to believe we have our students starting to trickle back on campus. It's good to see them. Classes start in about a week and a half, and so a lot of change going on. I am just in the next 30 minutes or so going to give you an update, keep you up to speed on things that have happened over the last couple of weeks in the world of tax. So let's go ahead and take a look at some of those important issues. I'd say one of the biggest areas that IRS seems to be focusing on right now has to do with withholding issues. And so it just seems from the things that the agency has been churning out that they are really intent on trying to help taxpayers get their withholding right this year, trying to help get estimated taxes more in line with what the taxpayer desires, and just clear up some of the confusion that came from last year. So with the new tax law, of course, we had quite a few people who were under withheld. A lot of people did not make the estimated tax payments that they needed to make, so they would have been charged a penalty under normal rules. But of course, we had a couple of announcements by IRS throughout the year this year that lowered the threshold for that penalty to apply. So on January 15th, for example, the 90% threshold was lowered to 85%. And then as returns started to trickle in and it became evident that perhaps more taxpayers were impacted, IRS further lowered that threshold to 80% on March 22nd. So of course you did not owe a penalty for underpayment of tax if your payment was at least 80% of the amount that you owed. Now that's for non-farming clients, of course. Also, in those notices, the IRS had waived the 4 installment requirement and said that the penalty would not apply as long as all those taxes in the amount up to the penalty threshold were paid by January. Now, what taxpayers were instructed to do to take advantage of this relief was to file Form 2210. And if they'd already filed the return at the time that these announcements were made, then they could file a Form 843 to request a refund. And there were specific instructions they had to follow. They had to write 80% waiver of estimated tax penalty on line 7 of that Form 843 if they had to request a waiver. And what we just found out this week was that IRS said it's now just going to automatically waive the estimated tax penalty for anybody who has already filed but didn't claim the waiver. So apparently there are around 400,000 eligible taxpayers who did not file a form to claim exemption from the penalty, but they were eligible for relief. And so IRS announced on August 14, all right, no need to request the waiver. We are going to just apply the waiver and we will send these taxpayers a refund. So there's no action required by taxpayers. In fact, IRS doesn't want you to do anything for your clients if somehow the proper request for an exemption from the penalty was not filed. IRS is just going to start sending out CP21 notices, and those notices are going to say that the taxpayer has been granted relief from the estimated tax penalty, and then they should get a check about 3 weeks later. So this is just one of those good news pieces, I think, for both taxpayers and practitioners. One thing that the notice does say is that this automatic waiver does not apply if you haven't filed your return for 2018. So this would apply to all of our returns that are on extension. So if you haven't filed, then you still are required to claim the waiver of the penalty on the return. And so the tax software really should handle this for electronic extensions. It should be smart enough to take care of that. If you're filing on paper for a client, just remember that you have to fill out and attach the Form 2210. So that's just all pretty welcome news, I think, for everyone in terms of an automatic waiver is always a good thing. Another development or change that IRS has been working on is to really kind of refine what they did used to call their withholding calculator. So for over a year, IRS has really been urging all taxpayers to do a paycheck checkup, and they've been driving folks out to the website to do calculations using the withholding calculator. And so just last week, IRS unveiled its new tool, and it's replacing the withholding calculator, and it's called the withholding estimator. And if you haven't been out there, you might want to check it out. It's a lot more streamlined. It's a lot easier to use. It gives a little more freedom to the taxpayer to set up parameters, whether they want a refund, whether they want to be right on target with their withholding. And the little application will go through and determine what it suggests. It will give a recommended amount of withholding, and it will do that, for multiple jobs and different situations. So I think it is a really nice upgrade from the withholding calculator. And so again, you should just go out there to the IRS website and check that out. I realize your software does a similar thing, but this is a pretty helpful tool, I think, for taxpayers and for practitioners as well. Another thing that came out last week was another draft version of the 2020 Form W-4. So IRS released this version on August 8th. The prior version had been issued on May 30th, and so that had been a pretty significant upgrade from the 2018 W-4, the 2019 W-4. But this new draft that we just received last week is really very similar to the one that was issued at the end of May. The IRS, when it put this August 8th draft out, it said, we're not going to make any more substantive changes before 2020. So this form, which will be released in its final form sometime later this fall, is pretty close. So we can depend on it and say, okay, here's pretty much what it's going to look like. So what changed are more cosmetic things than anything substantive with respect to the draft that was issued in August as compared to the draft that was issued at the end of May. The name of the form changed. It's now called the Employees Withholding Certificate. It's always been the Employees Withholding Allowance Certificate. And so with this new draft, they took out the word allowance, saying that it harkened back to the days of the personal exemption. So the withholding computation did not change. So really, again, like I said, this new form is substantively very similar to the form that we saw at the end of May. Here's a look at the first page of the new draft of the W-4. You can see a couple of things, wording changes, a little more explanation. If you look down where it says complete steps 2 through 4 only if they apply to you, it specifically says to see if you are exempt from withholding, or if you have concerns about privacy, see page 2. And so it specifically references the idea that if you don't want to put certain information about other jobs or special jobs, etc., on the first page of your W-4 where your employer can see it, go to page 2. There are worksheets that you can fill out and make those calculations. And so the worksheets are very similar as well, but now they have names. So in the original draft, the first worksheet was just called Worksheet 1, and now it's been renamed to be Multiple Jobs Worksheet. So of course, this is the worksheet that you fill out if you have multiple jobs. It will give you a recommended amount of withholding based upon those multiple jobs. And then the second worksheet, which was called Worksheet 2, is now called the Deductions Worksheet. And so this allows you to factor in some of your special deductions if you itemize to also help you figure out what your proper withholding amount should be. So again, if you haven't taken a look at the draft W-4, you might want to go out and take a look at it. It's out there on the draft forms of IRS. It's also linked on our website as well. So from this podcast landing page, I do try to put links to all the important things that we talk about out there, so you can take a look at this new form. The other thing that was just issued was the new draft 15T publication. So again, this was put out in draft form earlier this summer as well. This new draft provides separate calculations for forms W-4 that were issued before 2020 and for those for 2020 and later. So if you're involved in payroll, you might want to go out and take a look at that publication 15T, take a look at how that how the calculations work and the calculation methods that are set forth. But again, this is all just information IRS is trying to shore up for getting withholding correct for 2020. Another item that's of importance to a lot of our taxpayers are extenders. Now, of course, these are those kind of special provisions giving tax breaks to special groups. A number of these provisions on the list of what are commonly called tax extenders, they expired at the end of 2017, but they haven't officially been taken off the table yet. It hasn't officially come out from Congress, yeah, we're done with these, we're not going to do anything to retroactively revive them. We're not going to give these breaks anymore. There just hasn't been a policy decision made for sure. There are still a number of legislators who are working hard to retroactively revive some of these. And so in light of all of the questions surrounding how these extenders should work, one of the things being, gosh, if you're trying to incentivize development or reward certain behavior, it makes absolutely no sense to enact a provision retroactively so that you're not really influencing behavior. So there are just a lot of considerations. So a while back, Senate task forces were named to kind of study these extenders and hopefully come out with recommendations as to what to do. And there were 6 of these little groups put together. 3 of those reports were issued August 13. And so the 3 reports that were issued, one was from the individual group, one was from the cost recovery group, and one was from the energy group. And so if you've taken a look at these reports, one of them, the individual one is just 100 pages. The cost recovery and energy ones are longer. They don't really give any concrete recommendations. What they kind of do, they all sort of agree, yeah, temporary policy is not beneficial. A lot of the report's content is just the feedback that it received from different groups. So different associations, different industry groups impacted by these various extenders sent in comment letters or letters urging the Senate to go ahead and please retroactively restore these particular tax breaks. So you can look through those and see the kind of feedback they received. Senator Grassley has said that the Senate Finance Committee really needs to put together a legislative package after this has been compiled. So now that the reports are back, it's time for some action. So I know Senator Wyden, a number of senators are taking a look at what should be done. And so they're really looking at proposing some legislation that may be voted on in September. But I would say the one thing we got out of these reports is that there's just not a lot of agreement, bipartisan support for anything. So we're going to just have to kind of wait and see. It's possible we'll have some retroactive extenders go into effect, but we may not have anything. So let's just walk through the three groups and the reports that came out and just kind of remind everyone, what extenders are we talking about? Which ones expired that could possibly still be revived? And so you know this when you were doing your 2018 returns, that these particular individual extenders had already expired. So we did not have these in 2018 when we filed returns. One of those was the discharge of indebtedness on principal residence being excluded from gross income. So in 2018, on those returns, we had to include any discharge of indebtedness as income to the individuals. Also, the deductibility of mortgage insurance premiums on qualified residents, that deduction expired at the end of 2017 as well. So in 2018, we did not have that deduction. And then the last one was the above the line deduction for qualified tuition and related expenses. And that one also expired at the end of 2017. So one of the things that I think was most interesting about the individual report was just the little bit of feedback that they received on these provisions. The Cost Recovery Task Force looked at a number of cost recovery provisions, and this particular task force did tend to recommend that two of those are very valuable in particular. So it's not like they made general recommendations and made a determination for each of the 7 that they looked at here. But they did in particular say that of the ones they looked at, they really thought that the credit for expenditures for maintaining railroad tracks, which is under Section 45G, probably doesn't impact a ton of our clients, and the energy efficient commercial buildings deduction under Section 179D, which does impact a lot of clients, that those 2 provisions in particular probably have proven their worth and would be worth making permanent. The other provisions that they looked at and did not make a recommendation one way or the other was the 3-year depreciation for racehorses for 2 years or younger, 7-year recovery period for motorsports, accelerated depreciation for business property on an Indian reservation, election to expense advanced mine safety equipment, and expensing of certain qualified film and television and live theatrical provisions. So you can tell that most of those are really specific to a particular group of constituents, but the energy efficient commercial buildings deduction is much more general, and it did seem to have the support of this task force. So it would not be surprising if that particular provision was put into the package for vote by the Congress. Also, the Cost Recovery Task Force, they made some very general recommendations, and they said we really need to address provisions in a permanent way. We really need to be done with this temporary policy. We need to also revisit the impact of the Tax Cuts and Jobs Act on any provision that we look at. So they're asking for a little more look in a deep way in terms of how does, for example, the 100% bonus depreciation that we have right now, how does that impact some of these cost recovery provisions that they looked at? And then the task force said you need to address these in regular order, meaning that there needs to be a consideration of modifications that would stem from the task force work, and that there needs to be more study of that. So that was the cost recovery group. The Energy Task Force also made a number of recommendations. They tend to have a lot of provisions also that have some general support from a lot of groups, but the group itself, the task force itself, did not make any particular recommendations. There was a lot of feedback that came in with respect to these particular credits, and and special tax breaks. So these involve the credit for certain non-business energy property, the alternative motor vehicle credit for qualified fuel cell motor vehicles, the credit for alternative fuel vehicle refueling property, the credit for the two-wheeled plug-in electric vehicles, second generation biofuel producer credit, that's a big one, incentives for biodiesel and renewable diesel. Again, all of these credits expired at the end of 2017. Credit for electricity produced from certain renewable resources, credit for construction of new energy efficient homes, the special depreciation allowance for second generation biofuel plant property, and incentives for alternative fuel and alternative fuel mixtures. I didn't read all of them, but there's just a couple of extras that we didn't talk about. But again, these are all special energy credits and incentives that expired at the end of 2017. And so the Energy Task Force took a look at those. We are going to just sort of have to wait and see what legislative proposals come out. I would expect we'll start seeing those soon. And then in September, they may or may not make it to the floor. So we'll just keep watch. It's possible we may have some amended returns that we may need to do depending on what happens with the tax extenders. A couple of other things that were not addressed in these particular task force reports, but the medical expense deduction, just a reminder that lowering of the threshold to 7.5%, the floor, right? So you can take medical expense deduction for expenses that exceed 7.5% of your AGI in 2018. But this year, in 2019, you know that floor has been increased to 10%. So unless Congress changes that when we do our returns during the 2020 filing season, we will be having fewer clients eligible for this deduction because we'll have that increased threshold. Also, we have some tax breaks that are going to be expiring at the end of this tax year, 2019. So this is just a reminder of what's set to expire. These are just some of them. The credit for health insurance costs of eligible individuals, the beginning of construction date for wind renewable power facilities eligible to claim the electricity production credit or investment credit instead of the production credit, the new markets tax credit, the employer credit for paid family and medical leave. That was a new provision that was put into place by the Tax Cuts and Jobs Act, but it was only put into place for 2 years. So we were given this credit for 2018 and 2019, and unless Congress acts to extend that, we won't have that come 2020. And then the work opportunity credit, it is also set to expire at the end of 2019. So earlier this summer, if you remember, the Taxpayer First Act was signed into law. We discussed all the provisions about that in our last Call It Brief podcast dealing with tax. But today I just wanted to let you know that a couple of provisions are going into effect this week. And the one I wanted to highlight was IRS put out some interim guidance for the new third-party contact procedures. So those are now in place, and in all cases involving third-party notice, a taxpayer has to receive notice of that third-party contact at least 45 days before IRS makes that contact. So the old law said they had to give reasonable notice. I don't think it was usually 45 days. And so Congress came in and said that taxpayers needed more protection. And so they put in a hard and fast 45-day notice period. And so IRS did issue a letter to its team to say the IRM that's in place for the notice procedures is no longer valid. And so in the interim, you need to issue or follow these particular rules. And so they put out for IRS employees, some sample letters and things to use. And so here's an example of a sample letter where it says, we're writing to tell you that we intend to contact other people like your neighbor, your bank, your employer, your employees, etc. It gives some sample letters. The idea is that no one can be contacted until 45 days has passed from the time this notice is sent to the taxpayer. So just a little bit of added protection for taxpayers made possible by the Taxpayer First Act. All right, for those of you who do Iowa returns, I just wanted to let you know that Iowa has just published like-kind exchange rules for 2019. So for 2018 returns, the Iowa rule was that if you had an exchange of personal property, you were subject to the old federal rules for like-kind exchanges. So those personal property exchanges were tax deferred transactions. So we applied the old 1031 rules like they existed before the Tax Cuts and Jobs Act amended the law to restrict like-kind exchanges to only real property. So for 2018 Iowa returns, that was just the treatment that happened. For 2019, Iowa legislature said, okay, in 2019, we're going to give you an election. And so you can elect to use the like-kind exchange treatment for your personal property exchanges if that will be a better option for your clients. But if it's not, you can go ahead and the default is going to be to treat the exchange just like it's treated under current federal rules, which is if you're exchanging a tractor for a tractor, it's going to be a sale and a purchase. So since our Section 179 in Iowa is not yet coupled with federal law, so that happens in 2020. So in 2020, we're going to have the $1 million Section 179 deduction in Iowa, adjusted for inflation, that's going to correspond to the federal Section 179 deduction. In 2019, right, we're not there yet. We're still subject to the lower Section 179 deduction. And so the legislature allowed the special election for those who might be harmed by not having like-kind exchange treatment for their personal property when they don't have bonus depreciation and they only have a limited Section 179 to offset the gain from the sale of their depreciated property. So that's the impetus behind this law. And so what the new administrative rules do is just tell us how we make that election. And so this election applies to both individual taxpayers and it also applies to corporate taxpayers as well. So the election is made by completing the worksheets and forms and making the required adjustments on the Iowa return as described in a special rule which is called Subrule 40.83, subsection 3. And it says no special attachment or statement is required to be put on the return. And the election only applies to the transactions involved in the like-kind exchange. And it does say that the taxpayer may elect or not elect to treat other qualifying transactions as a like-kind exchange for Iowa purposes. So this is a really nice part of this rule, I think. It looks like taxpayers can choose. It's not an all or nothing election. They can apply it to one transaction, but not another transaction. So that is good news, I think, from these rules. And then the rules do give specific examples. So if you want to take a look at the rules, we link to them on our website. And I think there are some helpful examples. I've just put one of those here on the screen that just explains how the election would work in terms of applying the old like-kind exchange treatment for federal purposes to the Iowa exchange in 2019. So again, we knew this was coming. The administrative rules just give us a little bit more detail about how the Iowa Department of Revenue will be asking us to report these transactions. And another reminder for you who have clients who are truckers, Those Form 2290s are due on September 3rd this year. And so if your clients used their heavy highway vehicles beginning July of 2019, they have to file those Form 2290s by September 3rd. September 2nd is Labor Day, so it's a holiday, and September 1st is on a weekend, so that form is due September 3rd. The last thing I just want to remind you about is our September seminars. This is an annual event. We're holding it this year on September 23rd and 24th. We're having our seminar this year at the Courtyard by Marriott in Ankeny. So it's a change of location, but I think it'll be a great location, a central place for everyone to be able to gather. We also are offering this via webinar, and it's going to be videotaped as well. And we have a professional videographer who's on board working with us to live stream the speakers as well as the slides this year. So I think that'll be a great improvement. The Agricultural Tax Workshop Day on September 24th is going to include a review of important topics that are in our new Ag Tax Issues Workbook that is published by the Land Grant University Tax Education Foundation. So that is a 200+ page workbook that is the curriculum for the course. And we'll just be going through a number of issues that I think will be helpful for you as you work with agricultural clients. We have a couple of speakers we're bringing in. Guido Vanderhoven, who is from North Carolina State, and he is an agricultural tax specialist who has worked for a number of years, 30 years, I believe, in this area, as well as Glenn Birnbaum, who is a CPA from Illinois. Glenn is very active on tax Twitter, has a lot of helpful insights always in the world of the new tax law in particular. So I'm excited to have him join us as well. And I'll be speaking that day. And we also will have an hour of ethics by Kit presented that day as well. So it should be a great seminar. We are not allowed to give federal CPE for the first day, September 23rd, the Ag Law seminar, just because that day does not deal specifically with tax. Now, in the past, a number of you have come to that day. We think it's useful just for your business to understand some of the legal issues that your clients are facing. But day 2 is all about tax, and it's all about agricultural tax. So we look forward to that. In the meantime, if you have any questions or you have things come up, we always love to hear from you. And I hope that you're all having a little bit of a chance to have a break this summer, maybe get out to the fair. We'll be catching you soon. So thanks for tuning in.